Hi, I'm Jim Yent from Golden Years Advisors, the home of the Kairos formula. This is our second in a series of videos for our May update. And now what we want to jump into is probably a bigger concern. What could make that forecast go wrong? And the biggest piece is the Fed's tightening. Are we finally at a point that interest rates are going to pause? Well, the Fed never said the word pause, but they said everything but it. They said they didn't see as much of a need to be having more rate increases. And they said they felt that they were restrictive enough. So what has basically happened right here, they raised it up now. They did exactly what they told us. They had projected that they were going to get the rates over 5%. They did it. They announced between 5 to 5.25. So kind of in the middle is about 5.1, 5.13. At the same time, instead of buying treasuries, quantitative easing, they've been selling them off, getting rid of them, quantitative tightening. And that has put even more of stress on the credit markets and on the liquidity in general of banks. But they continue to do that, and their game plan is to move forward. So this is what happened in that 2022 time frame. In the early first quarter, they started raising it, and now they're up over 5%. Exactly what they told us they're going to do. The blue line is what the market believes they're going to do. And the Fed said they're going to stay there for the rest of the year and hopefully into next year because they want to make sure inflation is under control. In our last video, we showed you we're making progress. We got it down in the 4s on the way they look at it, but their target is 2, and they want to make sure they get there. The market says, that ain't going to happen. You're going to start cutting rates. And so if you look at the yield curve, you can kind of see the odds. Right now, the yield curve says there's maybe a 10% chance of one more hike, but that's very, very low odds. In general, the majority of what the yield curve is saying is by the end of the third quarter, fourth quarter, you're going to see at least a half-point cut. Now, why does the market feel that way? Well, there's kind of a history. The Federal Reserve often cuts rates. I mean, many people say they cut rates because they caused the problem, but they cut rates after there's some financial event. And if you look at history, this is from our friends at Clark Capital. After there's been some kind of failure, and by that we mean a bank failure, in the next 3 to 6 months, this is the history of what they kind of do. So whether it's Franklin National Bank way back in 1974, within that next 3 to 6 months, they cut like 250. Continental Illinois, that's the one I remember, was back in 1984, 150 basis points. So most recently, here's Silicon Valley Bank, as well as Signature Bank. Then we had First Republic Bank. And now we have 2 more banks, regional banks, that are wobbling. It's PacWest and Western Alliance. Their stock has fallen dramatically. But the first one fell in March. So the reason why the market's betting on it, saying in the past, you've always done this. So Fed, we believe you're going to do it again. So the key question is, if that's what's happening with the interest rates, what about the banking system? Because it's that failures that cause them to cut it. And remember, the other reason is when we did our outlook, we said the vast majority of the odds say a slowdown or a mild recession, but there was still in the teens, about 14% chance of a deep recession, which if you have a credit crisis, that would happen. So the banking system is a way that you could make things get far worse. So what's going on? Let's look on this left side of the chart. The blue represents the deposits on banks. And basically, if you look, gray bars are recessions. So that thin bar, that's COVID. When COVID happened, basically we had a 10-year influx in the span of about 18 months when our government rained down on both corporations as well as consumers money from heaven, stimulus money, stimulus checks. And literally it was a $10 trillion increase. And so we didn't need to spend it all right then. People started spending it. But where did it go? It went into the bank account. So the bank's deposits spiked. At that point, interest rates were near zero. So at the worst possible time, all these banks to try to put it in a safe thing in US Treasuries, which was earning nothing at the lowest rates ever. So what happened, the dark blue is, well, you can already see it here. By the time we hit 2022 onward, deposits started coming out. And where they came out first, the dark line is the large banks, the systemically important banks, JP Morgan, Bank of America, et cetera, those types of banks. And in May of last year, that's when they had their peak deposits. And it started sliding out because corporate customers and some of the higher net worth people started saying, you know, forget this low rates. I'm going to get money markets or some short-term treasuries that are paying higher. This is the regional and smaller banks. It hit its peak this March of 2023, and it's precipitously dropped because there was panics as to whether these banks are still going to have my money, you know, if there's a problem going forward. So that's what happened on the deposits. Deposits were running out on the big banks last year, but at a slower pace, but out of the smaller banks, super fast. And remember, they invested it all in safe things. They wanted your money to be safe, so they put it in treasuries. Well, treasuries have lost all last year. You know, the shortest term, you know, the shorter term treasuries had losses. The intermediate treasuries had double-digit losses. And the longer dated treasuries, they lost as much as the NASDAQ. They had 30% decreases in value. So the bigger banks, that's the blue again, they weathered it better because they're more sophisticated, just to be blunt. Whereas a lot of the smaller banks didn't have the sophistication on how to hedge all that interest rate risk that was happening. And then when people asked for their money, they were forced to sell supposedly the safest thing on the planet, the long US Treasury, at 20, 30 cents off discount prices, and it just wiped them out. And that's why those banks have been falling. So, you know, what has the Fed done about this regional banking crisis thus far? Well, both the Treasury, the Federal Reserve, and the FDIC, they did what they call a ring fence. It's just a fancy way of saying we're going to put a firewall. Wherever we see something on fire, let's surround it with things that can't be burned to try to put out the fire. And the hose that they're using to try to put out the fire is money. They're literally throwing liquidity at those by creating the Bank Term Funding Program, the BTFP. Here's the deal to those banks. If you're, you know, scared that, oh my gosh, people are demanding their money back, and you're going to have to sell things and lose 20, 30 cents on the dollar on every one of them, come to us, come to this funding facility. We'll give you dollar for dollar what that thing should be worth at its face value, and we're only going to charge you a small fee in the interim. So the key question is that sufficient? Time will tell. As we said, more banks are still wobbling, and all the problems thus far have really been contained here in the US. Let's see what happens if it spreads out to other sides of the globe, Europe and other places. So that's what's going on the regional bank front. Stay tuned for our next update, and we'll keep our eye on the markets for you.